Go.
Excellent.
Welcome to another episode of the Indy Investor Pod. I'm Brett Snodgrass, and today we're going to talk about how real estate investors should pay zero taxes, the strategies that real estate investors can use to pay zero taxes, and everything in between. And I'm with my good buddy, Casey Meyeres from Phoenix, Arizona. Let's get on with the show.
Hey, Brett, thanks for having me on.
And welcome back to the Indy Investor Pod. Casey, what's up, man?
Hey, how's it going?
It's going fantastic. Thanks for being with me today. Appreciate
Sure,
you.
definitely.
We've known each other for a couple of years now, and I think it's been a good journey together.
I think so. Done some good planning together for certain.
Definitely. I didn't do any tax planning before that, so it's actually been really helpful for me. But Casey, I want to have you on the show. We've had a lot of investors ask for how do I reduce my tax liability? How do I plan for taxes? And one of the comments that you made that's going to be ingrained in my mind for the rest of my life is we had that very first call, and you said, if you do it right and you are a real estate investor, you should pay zero taxes. And I did not know that because I have paid my fair share of taxes throughout the 13 years of doing this business. But that kind of just struck a chord with me. And that's why I wanted to have you on this show, is to talk about the different strategies that real estate investors can use to reduce their tax liability and eventually, hopefully, pay zero taxes, right?
Sure.
Before we go into kind of the strategies on how to do that, I just want you to kind of tell a little bit about yourself. I know you work with your own partial owner of a company called Provision out of Arizona, but I live in Indiana, and we use you for our CPA and accounting services. But why don't you just kind of tell your story real quick so the audience can get to know you a little bit?
Sure. So Provision, I would say 80, 80 to 85% of our clients are not in Arizona. So I've been in Arizona my entire life, but most of our clients are not in Arizona. So very similar to your situation. And Provision kind of fits that need as far as we're the proactive tax planner. So with each of our clients, we put together a plan for them. We look at kind of lay out their situation on the table, put all the cards on the table, shuffle them around, and look for the best ways to minimize their taxes. And so, sometimes to get into a tax situation, a favorable, efficient tax situation, you have to change your facts. And a lot of the things that we do together are show you, hey, well, this is where you are today. If you were to do, A, B, and C, then we could get to the point where, ultimately, hopefully, you can pay zero tax if you're into real estate. Personally, so I've been in public accounting since 1998, so 23 years. So joined Provision in 2012. Prior to that, I worked for the world's largest public accounting firm. So I've been doing real estate since 1998. I've seen the ups, I've seen the downs. So it's kind of interesting. So when you see the upswing, you have all the 1031 exchanges, and when you see the downswing, you have all the cancellation of debt. So and bankruptcies. I've been on both sides of the equation, and whether it's going up or it's going down, there's definitely always ways and opportunities to save taxes.
Yeah, for sure. I was always the entrepreneur that I didn't really worry much about my taxes. It is what it is. And I obviously did my tax returns, paid my fair share of taxes, but I never really did a lot of planning. And that's where you guys came in. I mean, we had numerous calls about my business digging into, what I was doing, and you guys giving me certain strategies that could help reduce my tax liability. And the thing is with entrepreneurs, every year is a little bit different, right? So I feel like you
Definitely.
always have to constantly be on your game when it comes to tax planning, because this year, some people might have had the best year ever. Some people had the worst year ever, right? 2020. And I want to kind of just dive into some of those taxes. So thank you so much for sharing your story. Who do you typically work with? Is it all real estate investors, other business owners? What's your typical client?
So our typical client would be anyone that's an entrepreneur. So we have small business owners where they have, millions, maybe even hundreds of millions of revenue. And we have the small mom and pop that have, one or two rentals. We have a lot of doctors that are getting into real estate. We also have a lot of highly paid executives that have a spouse that's getting into real estate. And so there's some different strategies on that where we can help take the real estate losses and offset the spouse's wages. So really our criteria is anyone that's an entrepreneur. So that's really the best way to help save taxes. If someone is a W-2 and they have a 401k plan and that's what they plan to do for the next 20 years, they could save money and not use provision. Our fees are definitely not the highest, not the cheapest, but you could do TurboTax on your own and be just fine. There's not a whole lot of value I could add in those situations. So the entrepreneur is where the tax code is a series of incentives, and they're really for business owners. And so provision, we look for ways to maximize those incentives and put them in play for our clients.
Love it. Love it. So the entrepreneur out there, if you're an entrepreneur, if you're a real estate investor, this is for you. And this isn't a plug for Provision. I will tell you that
Sure.
I've been in real estate for 13 years. I've had a lot of CPAs and accountants that I've come into contact with that have done my returns and helped me with my business. And even a decade into doing this business, I still didn't really know what I was doing when it came to taxes. My accountants and CPAs never really helped me plan. They did my returns and helped me there, but a lot of times I was writing a large check when it came tax return time. And so I met Provision and had to find someone out of state, and here we are. And I obviously work with Provision for the last 2 years, and they've really helped me and continue to do that. And so let's go back to that statement, Casey. You said real estate investors, if done right and correctly, should pay zero taxes. So I want to just talk about some of the strategies. So let's just kind of go through, the top strategies of how to reduce your tax liability, because, if you're doing well as an entrepreneur, you're making a lot of money, and culture in the world says that, well, if you make a lot of money, then you pay taxes. But you
Sure.
say that that's not true all the time. So let's go through a couple of the strategies and just kind of, you can go through and I can ask questions just with each one. So what's the top one?
Definitely. So if you look at the current tax law signed by President Trump, he's a huge real estate guy. So it's really not surprising when the press comes out and shows returns where he paid zero taxes. So the biggest play with real estate is depreciation. So that's the tax loss, or paper loss that depreciation carries. So when you have a residential rental, you get to take that depreciation or tax loss over 27 and a half years, so straight line. Under the current law, you're actually able to use bonus depreciation, which is currently at 100% for any assets that are less than 20-year life. So that would be, fencing, landscaping is a 15-year life. You have the internal components of a building that are 7 and 5-year life. So under the current code, you actually get to take 100% write-off in that first year. So if you look at, kind of just a rule of thumb, and every property is different, but on a residential rental, typically 25 to 40% can be written off in that first year. So as far as a general rule of thumb, I look at about 30%. So if you were to buy a $100,000 property, you could expect, if you were to do a cost segregation study, and we can talk about that later too, but you could actually get a $30,000 write-off. And so extrapolate that into $1 million property. So let's say that you put 20% down, you have 200,000 of cash into this deal. Your $1 million property now generates 300,000. So very rarely in the tax code are you able to get a deduction bigger than your actual investment. So the bonus depreciation in the past was only on new property. So you'd actually have to construct the property. Under the Trump Tax Act, it's new or used property. So as a real estate investor, I can go in and buy a property that's been around for 20 years, go in, get the depreciation. If I buy $1 million of property, I get a $300,000 tax loss that I can use to offset my other income if we can turn that passive rental loss into non-passive. So rental real estate loss by default is considered passive and can offset other passive income. So if you don't have passive income, that loss just kind of hangs out there and waits until you either dispose of the property or until you have some passive income. And so if if you're making under 100,000, the IRS gives you an exemption to take 25,000. That's kind of their token gift to you, that you can take up to 25,000 of loss if you're making under 100,000. Once you get over 100,000, it starts phasing out. Once you're over 150,000, that your rental losses, if you are basically passive, unless you can then convert it. Either you can either convert the rental loss from passive to non-passive, or if you have other business income that's active, you can basically try to convert that to passive. So there's some different strategies there.
I just want to ask
Go ahead.
I just want to ask a couple questions. So I was a math teacher, and so sometimes I geek out on numbers, but it's pretty black and white. So so what you're saying was, and we had this conversation literally a couple months ago. So we've had a really good year. I've made, some decent money, and most of my money is from wholesaling or buying and selling properties, flipping properties, things like that. So it's very active income. And I don't do a lot of buy and hold properties. And, your comment was, Brett, why don't you buy some and hold some properties so you can take some of the depreciation, especially the bonus depreciation. And so, an example would be if I'm going to make, $500,000 this year, as an example. One thing that you talked to me about was, if you buy $1 million property, typically if you do a cost segregation study, which we'll dive into a little bit, and you can write off 30% of that. So you can write off about $300,000. So now I'm not really showing I'm making 500, I'm making about 200, right?
Exactly.
And plus you got a lot of the deductions with that anyways, and you're in a lower tax bracket. And, I just saved how much, if I'm in the 40, 40% tax bracket, $300,000, you're saving, $100,000, I guess. And then you're not paying that to the government. And then as a real estate
If you think about
investor,
that,
you can grow that.
120,000, you
Yeah.
buy another property at 500,000, and now you have another $150,000 deduction, and you can kind of keep that wheel going.
Yeah. And that's honestly, you guys, this is really want to this is how wealth, I believe, is created, obviously, because taxes is our biggest expense, whether you know it or not. And so the example that I just painted, right, is you went from literally paying 100 to rough numbers, 100 to $200,000 or more in taxes. Now you have an asset that is creating cash flow. So you have that. You're not paying that money to the government. So you get to keep that money and then use it for something else to grow wealth, right? Is that pretty much the name of the game, Casey?
Government wants you to do.
Yeah.
I mean, the tax code is there to incentivize you. And right now, those are the incentives, is to go out and keep developing, keep creating, buying more real estate. So
Definitely.
You're doing exactly what the government wants you to do.
So let's talk about the cost segregation studies. That's obviously something that you don't particularly do. You have to outsource that to some sort of a engineer. Let's talk about that, because that's something in order to take that much depreciation, right, on that property, do you typically have to do a cost segregation study in order to write off that much percentage?
Yeah, exactly. So typically, if you had, let's say, $1 million property, and you did 80% of that for building and 20% for land. Land is not depreciated, so the smaller you can get the land value, the better. But typically that $1 million building over 27.5 years, if it's residential rental, if it's a commercial property, it'd be 39 years, so even less depreciation. But on that typical $1 million property, you'd be looking at about 29,000 of tax depreciation each year to offset your income. So not a ton. If you were to do the cost segregation study, you're looking at, let's say, 300,000. So that's a huge swing in that year one. So most accountants will say, okay, Brett got $1 million building, great, 80% building, 27.5 years, take your 29,000, have a good day. And, the other 20%, 200,000 goes to land. You'll get that to offset capital gain if you ever go to sell the property. So that's what most accountants do. If you come to us, we would say, how could you let this opportunity pass you by if you're a real estate professional, or if you could use it. There's also some strategies to use as far as if you're not currently a real estate professional, but maybe want to get that in a future year when you are a real estate professional. So,
I love it.
So that cost segregation study is done by kind of a quasi engineer / CPA. And they take that, in our previous example, that $800,000 building, so $1 million building, but 80% building is 800,000. They basically take that and do somewhat of an inspection appraisal type kind of. They slice and dice the property into different components. So they'll look at the outside, the fencing, the parking lot, those kind of structures. They'll look at the inside, cabinets and different types of flooring and doors. And then they'll look at appliances for a 5-year. So anything in that 15, 7, or 5-year category, they'll carve out and they'll say, of that $800,000 building, 300,000 of that is related to 15-year property, 7-year property, 5-year property. You get that 100% expense write-off in that year, and then the other portion, that remaining 500,000, would be depreciated or expensed over the remaining 27.5 years. So you're still going to get some depreciation over the remaining years, but you get that big bump in that year one.
That big bump, yeah, definitely. So, an example, I only know my personal experience right now is that, again, this year we were having a pretty good year, and I've been buying some assets to get that big bump, obviously. And cost segregation studies, is there like a formula? Like, I don't really know what a normal cost of something like that is. Obviously, it depends on the building, things like that. But is there a normal, like, I don't know, percentage that cost segregation
I've
is
seen
typically
them range anywhere from $2,500 to $10,000. So
Yeah.
depending on the type of building, and there's plenty of companies that do it out there, but somewhere in that range. Which before the tax law change on $100,000 property, it may not make sense because maybe you're getting $3,000 cash tax savings, but you just pay $2,500 for a cost seg, so your net $500. Under the current, it's more like on that $100,000 property, you might be getting $20,000, $30,000 cash tax benefit versus the $2,500. So in more times than not, it's making sense under the current tax law to get that cost seg done.
And this is why it's so important to really plan, guys, and to really look at this, because that's exactly what I've been doing. I've been looking at, okay, I'm going to be paying this much in taxes. How can I reduce that? If I buy this $100,000 property and I pay $2,000 for a cost seg, I'm going to be in the 40% tax bracket. I can save $30,000, right? So paying it's just a math problem, paying $2,000 to save 30. And a lot of people, your minds are spinning right now, just like mine. I don't know how to do a cost seg study. I don't know how to do any of that. I don't know how to do the depreciation like Casey does. That's why I outsource this to professionals. So all I do know is if I hire this engineer over here to do a cost seg study, they charge me a couple grand to do it. They give me the cost seg study, which I give to Casey, and Casey does his thing on my tax return, and I save money. Right.
And really the cost seg is the proper way to do it. And it's so proper that, the lazy way of doing 80% over 27.5 years, that's kind of the lazy way of doing it. The proper way is to truly have a cost seg on every property. And so it's so much the right way that, let's say that you bought a property in 2019 and now you're looking at 2020 doing your tax return. The IRS will actually let you catch up. They'll let you change your accounting method to the proper one. So you were doing it improperly in the past. You bought this property, you were doing it straight line, 80%, you're getting your small, 1/27th each year depreciation. You got a new CPA that said, hey, you're doing it, not the most advantageous way, and it's also not the proper way. So you could actually do a cost segregation study for a property that you purchased in the past, and then take that difference. So essentially you'd look and say, how much depreciation have I taken since I bought that property? How much should I have done if I did it under the proper cost segregation way? Okay, well, that difference is, 220,000. So you get to catch that. The IRS lets you catch up that missed depreciation in that year when you do that cost segregation study. But you also have to do change of accounting method. So it's not as simple as it seems, but there is a way to basically catch up on that missed depreciation.
Definitely. That's awesome. So guys, if you want to research cost segregation studies, and I have some other contacts that can help do cost segregation studies if you're interested in that. And obviously, accounting questions, things like that. If you want to set up a meeting with Casey or Provision, then you can definitely do that. Casey, I want to just dive into just a couple other strategies here. So we talked about the cost segregation study. That's the best strategy. I mean, that's the biggest bang for your buck. It's simple. It's
Definitely.
easy. It's not super complicated, and you outsource that. What are some other strategies that other entrepreneurs can use to reduce their tax liability?
So if you're in the fix and flip business, let's say that you make $500,000. Well, let's say you make $200,000 of income. So you're doing great fix and flip. So $200,000 of income. You don't have any buy and hold rentals to take that depreciation. So you have 200,000 of income. So some of the strategies that most fix and flippers aren't not aware of is that 200,000 is going to be subject to your, let's say, 25-30% federal income tax. But it's also, you're going to be paying the majority of that with FICA taxes, so Social Security, Medicare taxes, which is 15.3%. So you could be paying half of your fix and flip profits to the income tax and also payroll tax or FICA tax for that. So, a strategy that we look at there is, we see a lot of fix and flips. They're filing the Schedule C on their individual return because it's easy. They either do TurboTax or they have a CPA that, we'll just file it on Schedule C. It's easy. What we like to do, couple things is use entities. So entity for asset protection, because if you're doing fix and flip and it's in your individual name, you're completely exposed from an asset protection standpoint, but also you're paying the highest tax that you could. You're paying the FICA tax on top of the income tax on the majority of that income. And so if you were able to set up an LLC and have it elect to be taxed as an S corporation, now that S corporation is not subject to the FICA taxes, Social Security, Medicare taxes. The IRS wants you to pay yourself a reasonable wage for what you're doing. So essentially, you would look and say, well, what would I pay someone else to do this? So I made $200,000 of profit. My business is on cruise control for the most. I just kind of oversee. Maybe I would pay someone $50,000. That $50,000 wage would be subject to the 15.3% Social Security Medicare tax. The other 150 is not, and so that's a pretty huge savings just by basically doing nothing else except for creating an entity, making sure it's taxed the right way, and setting up some payroll.
No, I love that. That's a conversation that we had because I have multiple entities. I have some S corps. I also have some LLCs that go on a Schedule C. And not to get too tax complicated, guys, because sometimes especially if you're brand new to this and you haven't talked about any of this stuff, it can go over your head. But basically, what Casey told me was, I don't want you to have any Schedule Cs on your personal tax return because you have to pay that extra 15%. 0.3%, self-employment tax.
In addition, when you have a Schedule C, you're about 10 times more likely to get audited by the IRS than you would if you had an entity.
Wow, that's crazy. So, if you're in any type of active business, what do you recommend, Casey? Fix and flipping, wholesaling, or buying and selling properties, any type of active business, run that through an S corp.
Correct.
Yep. Pretty much.
Yep.
And then what about the passive business? Passive means, so you want to save on taxes. So you want to do, you want to buy some rentals and you want to do some of these cost segregation studies so you can depreciate and save on taxes there. Should you buy those in an S corp or should you buy those in something else?
Right. And so I've seen plenty of clients that come to me and they have S corporations. They're doing some fix and flips in it. And then they also have some buy and hold rentals. And they have an entity and nobody told them otherwise, but essentially, without getting too much into the weeds on S corporations, it's possible that you have a financed rental in an S corporation, you're thinking, hey, great, I had this $1 million property. I'm going to get this $300,000 loss. It's possible by having it just being in an S corporation, you're not going to be able to take that due to some basis limitations. Where if all you did was basically either have a family partnership or an LLC tax as either disregarded entity or a partnership, just by having it not in an S corp and having it in an LLC, not taxed as an S corp, you could actually free up those losses and utilize them. So I've had plenty of clients that have the S corp situation for rental. They really should have it in an LLC, not taxed as a corporation or an S corporation. In addition, I've seen clients that have their, let's say it's a 500,000. Let's say they had a rental property and they bought it for 300,000. Values have gone up. They have it in their S corp. They want to refinance it. You have to refinance it in an individual name. You can't do it through the S corp. So, okay, me owning this property through my S corp, I distribute it out, put it in my individual name, refinance it. Okay, great. Bank gives me 80%. So I'm cashing out 400,000 on a $500,000 property. I put the property back in after the financing is done, back into my S corp. Great, everything's good. Basically from before financing, after financing, it's both an S corp. I think no harm, no foul. You go to do your tax return, you see that, and you actually triggered a sell. You basically, when you distribute that out to your individual name in an S corporation, it's treated as if the S corp sold it for that $500,000 value. So even though nothing changed, except maybe you now have a lower interest rate, you're going to have a tax gain of $200,000 that you're going to have to pay tax on this phantom income. So, by doing some planning, making sure you have the right structure, and you're talking to your CPA before you do these transactions, you can help try to mitigate that, because it's really hard. If you come to me in April and we're doing taxes and I see that you did this, it's really hard to retroactively tax plan. So that's part of when I say our clients come to us, we kind of put all the cards on the table. I really get to know my clients, what they're doing, and how we should kind of restructure things and say, well, here's potential issues here, here's potential issues here, here's one way we could reduce it, here's another way we can reduce it. It's definitely, as a series of meetings, it's not, you're not going to get everything in 1 hour and be able to take it and run with it. So
definitely. And that's exactly, I think we've had, I don't know, probably 10 meetings over the past couple of years, and on tax planning, not just the return stuff.
Sure.
But you're exactly right. And entrepreneurs we're all just messy, right? It's like, we start this business, we don't know how to really run a business. So we start doing these things and we start to develop these bad habits because we never had to ask permission when we started our business and anything like that. And we just start moving money around, transferring properties around, just whatever can make it work. And we don't ask these questions, right? So now, before I really start to do things like that, I start to ask, hey, is this, what's going to happen here? Should I do this or should I not? Or is there a better way? With all that. So that's awesome. Let's see, any other just real quick strategies. So we've talked about the cost segregation study, the bonus depreciation. We've talked about obviously transactional businesses going through S corps and paying yourself a reasonable wage. Any other, I don't know, one more?
Yeah. So we always look for low hanging fruit. So, it doesn't make sense to spend $100 to save $20 because you're still out $80. But if you're spending the $100 already, and most entrepreneurs, I would say probably 95% of what they do is business related, because they're hustling. They're trying to make that money. So if you can structure that $100 as a business expense, now you're getting that benefit. So you're already going to pay $100 for whatever reason. If we can somehow classify that as a business expense, now you're getting the tax benefit on that. So we always look for the permanent ways to reduce your taxes. So if there's some expenses that you're doing and maybe you're not getting any tax benefit for, we kind of scrub those, look through that. A lot of people have a home office, especially with COVID. Everyone seems to have a home office. So if we could take some of those rent payments that you're making, the mortgage payments, the property taxes, pest control, and basically get some kind of benefit for that. That's another kind of low hanging fruit item. take those expenses you're already putting out of pocket and turn that into a tax deduction.
Yeah.
A lot of our entrepreneurs also have kids, and so there are some strategies to basically pay your kids, and really the first $12,200 that a child earns is tax free under the current law. And so let's say that you have 4 kids, you pay them each $12,000 a piece for bona fide work. That's $48,000. So if we're at $300,000 of income, pay them $48,000. Now you're about $250,000. So you basically turn $50,000 of tax that you're paying in, which would be, let's say, $20,000 of tax that you're paying to the government. Now it's going to your kids. You can actually, they have earned income. So let's say they wanted to do a Roth IRA or a Roth 401k plan. You could basically take those earnings, grow it tax free, and the kids turn 20, they go to college, and now they have this pile of cash to use for college, schools, investments, that kind of stuff that that essentially you've never paid any tax on that.
Wow. There's so many strategies out there, guys. I think the best thing for me is everyone does something a little bit different. It's nice to have someone just evaluate your business. And if you've never had someone, just to kind of like dive in and look and see what you're doing. And sometimes it's like, if you show somebody exactly what you're doing, you get some fear because you're like, I don't think I'm doing everything right. And they're going to tell me everything I'm doing wrong. And I don't want anybody to know that I'm doing this, right? But I think it's so good. And that's what, Casey, that's what's been so good, because I've always had that fear, like, man, they're going to make me do all these different things and it's going to be so complicated. I'm never going to get through it. I'm going to have an LLC set up for every single property. And you guys do talk about that, but I think it's just, you've also really helped fit what I want, because I'm a simple person. I want it simple. I don't want to be so just super protected, but super complicated either. Right.
Sure.
So I think that it's just a great way to have someone like Casey. And if you already have an accountant, and I want to ask you this, Casey, you've mentioned this before, is like I said, I've had a lot of CPAs and accountants, and are they all cut from the same cloth? Like I said, I was a math teacher and I took accounting. I went to business management. We took an accounting class, and they talk about accounting. And, you've mentioned on this show already about most CPAs will say this and do this, but you do something different. So what would you recommend with that?
I would say most CPAs look at clients as basically tax preparation. And so obviously we do tax preparation because we look at it more as a report card. For all the planning that we did, we want to make sure the plan that we did in 2020, when we go to do your 2020 tax return, was correct and in play. So we definitely do the tax compliance piece of it, but that's usually where most accountants or CPAs kind of start and end. We like to develop that plan first, and part of that plan is asking a ton of questions. So we've had 10 meetings together. That's not just me educating you the whole time. That's me really getting to know you and your business, and look to say, well, if you were to do this, this, and this, you could save some taxes. There might be some things hey, well, you could save $1,500 of taxes. You might say, well, that's not really worth it to me because I don't want the hassle of doing this, and that's fine. There might be other things. I have some clients at $1,500, anything that they can save and not give to the government, they prefer to do it, and they'll do everything. So every client's different, but it's really up to the CPA, to the accountant, to know your client and to ask those questions. So, if you're getting your tax preparation done, great. If they're asking no questions, except at the end of the year, they say, hey, give me your IRS forms and I'll prepare a tax return. Give me your financials. They don't ask you any questions. You just get a return at the end. That's you're probably missing out on something.
Yeah, definitely. I got 2 questions for you before we wrap up this show, Casey. Sure. I get this question today. I was talking to a friend of mine. We were talking. I said I was getting ready to have this show with you, and I said the comment that I started this show with, that if you are doing it right, you're a real estate investor, you should pay 0 taxes. And their comment was, how is that legal? That can't be legal. We've seen right. Donald Trump come up with whether it's true or not true, whatever. I'm not here to talk about that, but Donald Trump, if he did pay $750 in taxes, that was the big thing. How can that be legal? What's your comment on that?
the tax code is a legal document, and so it really is about incentives. So, Congress and Senate, they come up with these rules, and they want you to go in a certain direction. And so if you basically jump through those hoops of what they want you to do, you're doing exactly what they want you to do. You're getting benefit for that. So if part of it is buying property and you're getting the depreciation, that's great. If part of it is being a business owner, and let's say that you employ 30 people, 30 staff, really the government taxes are really set up to penalize employees, to penalize the worker. So if you created a business that now has 30 employees, you're really helping the government, because now they're collecting a lot more payroll taxes, they're collecting a lot more income taxes. That's what they want. Mm-hmm. And so it's not only legal, but that's what they want. So as long as you can understand the tax code and basically structure to hit those incentives, what they want, that's completely
and I think that's
legal.
I think that's a good reason too, right? Because you're talking about, let's just take, if Donald Trump, whether he paid taxes himself or whatever, but the hundreds of employees that pay taxes through, right? I mean, that's big, and I think sometimes we just forget about that, right? So that kind of answers that question. Last question before I want to kind of wrap the show up, Casey, and then you can give your information if anybody does want to, contact Provision. Is
Sure.
So who knows what the future is going to hold? This has been a weird year, 2020, and who knows? Right now, the show's getting ready to come out, and we're still. I don't know. We're still kind of in limbo, I guess, exactly what's going to happen. But, you kept talking about, Donald Trump and the tax law that he put in, the bonus depreciation, really helped the real estate investors. Do you have any prediction on if this does move to the Biden administration on, as a real estate investor or an entrepreneur? Is there something that we should prepare for, just to kind of wait and see what happens? I don't know. Do you have any kind of comments on that?
Right. So some of the favorable bonus is going to be phasing out. So 2021, 2022, we still get that 100% bonus depreciation. It starts phasing out to 80%, to 60%, to 40%. So the laws is basically set to sunset. So there will be some changes in the current administration. How drastic those changes are, it is really unknown. So I don't anticipate a lot of changes in the first year. I think Obama took 5 years to get some kind of tax to changes to go through. So, you're looking at politically, can you afford it? In a couple things. One would be the Senate. So, looking at Georgia, they have the runoff. I think it's January 5th. If both of those could have, or even if it's a split, but essentially for any tax policy to really effectively change, not just corrections, but actual change, you would have to have both of those be Democrats to have any possible ability to get anything through. So, chances of one being Republican, one being Democrat, probably not going to be a lot of tax law change on that. So, but let's say that two Democrats get in from Georgia. Now they have the majority. Well, it's actually a tie, but then the vice president gets the tiebreaker vote. So that tiebreaker vote would likely go in favor of Democrats, and so tax law could change on that. But then you're also hopefully coming out of a pandemic at that time. I don't think any political, again, I'm not a political advisor or anything like that, but I don't think they would have enough capital to basically say, yeah, let's do something that's going to hurt the economy.
Right.
So
yeah.
I think you're looking at a couple years at least before there's any kind of real tax reform.
Okay. And the other thing as a real estate investor, obviously to look at is, on the other side of this, beyond all the taxes is, could there be a transition? So you might be having all of these tax things happening, but on the other side, there could potentially be a lot of great deals out there, and making
Exactly.
money. So,
and I've had clients, they've not paid tax since 2000, and they're buy and hold rentals, whether it's apartment complexes. So, and that's been many different administrations, many different tax law changes, and they've still been able to. So real estate has always been in favor of the U.S. government. So, there could be some changes. There could be some kinks that get changed. But as far as real estate, I think it's probably your best investment for wealth building, but then also how you can parlay that with tax savings and really just kind of exponentially grow your wealth by taking those tax savings and rolling them into future properties.
Amen. Awesome. Casey, thank you so much for being on the show today. Answered so many great questions. I know there's actually a lot more that we could dive into.
Definitely.
And I really appreciate your honesty and transparency in this. If we have one of our listeners that is interested in hearing more, they're not happy with their accounting firm, CPA, is there a website that they could go to if they're interested in reaching out to you and have any questions?
Yep. The easiest way is to go to provisionwealth.com. So it's just provisionwealth.com. They could also call us at 480-467-4400. So we have, I would say probably 40 to 50 team members. So if it's not me that you're able to get a meeting with, we have plenty of people that all subscribe to the same philosophy. And again, we take clients across the nation and also in foreign countries as well. But so we're pretty open. We have a lot of great information on our website. You can definitely see our team members there. And basically, I think there's just a contact button and it'll submit an email, and then we'll have someone get back to you and schedule up a consultation.
Sounds good. That's provisionwealth.com, guys. So check that out with Casey Meyeres and the Provision team. This is a wrap with the Indy Investor Pod. Thanks, Casey, for being here, and we'll see all you guys next time.
Appreciate it. Thanks, Brett.